Okay,
All
welcome,
right.
welcome back. This is our second kind of Summer.Fi kind of internal podcast in a way, and I'm back with Jordan Jackson again as well, who previously we talked about automation, all the different types of automation you can do, and yeah, today we're here to talk about the different products available in Summer.Fi: borrow, multiply, and earn. But first of all, Jordan, welcome back. How's it going?
Thank you. It's going great. How is it going for you?
Good. Yeah. All well. Thank you. So yeah,
Good. Good.
we had a successful time talking about automation before. And as I just said, yeah, we talk about borrow, multiply, and earn. Ideally here, like trying to like set the scene about like what we're going to be talking about. Really, this is to help kind of new users if you haven't navigated Summer.Fi before, or if actually you're just unsure, maybe you're even using Summer.Fi, but you're unsure about actually the different use cases that's available to you, and you just took the kind of first option that was available to you, maybe. This is going to be a great way, hopefully, for you to discover kind of like the difference in the products, what crucially they are, why you would use them, the kind of use cases for them, and then we're going to talk about the different values that each one has to offer, and so on. So, I think let's just dive right in. Jordan, you're going to be kind of like our Bible here, telling us exactly kind of what's what. But let's start off with borrow. Like, what is borrow in Summer.Fi?
Yeah. So I really think of borrow as like the ability to get liquidity for your crypto assets. So maybe that's kind of like some buzzwords, so to speak, or something like that, or maybe they're a little bit fancy of words or something. But really, I think maybe it's best to think about like the situation that people find themselves in, or I find myself in. I know you've maybe found yourself in. And maybe we can talk about some examples of like when it's actually best to be able to borrow. But basically, especially in DeFi, obviously in crypto, you have these crypto assets: ETH, wrap staked ETH, Rocket Pool ETH, wrap ETC, maybe something else, which we can talk about when we talk about some different protocols and stuff if you don't have those major crypto assets. But basically, there's a lot of potential energy, let's say, in those assets. So maybe you don't want to sell them. Maybe they went up a lot in price or something like that, especially as we get started with this new bull run, or maybe you got them last bull run. And a lot of times, if you don't want to sell them, you want to still get some money out of them, some liquidity out of them. And that's basically what borrow is. It allows you to deposit your crypto assets in one of several different protocols that we curate for trust and other different attributes and stuff like that. And you can get liquidity. You can borrow stable coins generally, but also other assets against those crypto assets that you own without giving up control of them or anything like that. So simply put, I think just a way to get cash basically from your crypto assets for a cost. And yeah, there are really some specific things that you can do, but that at a high level is basically why people borrow and what it is. How do you think about it?
Okay, great. Yeah. So I guess like kind of summarizing that up then, so like if like I'm holding ETH, and I want to borrow against it, like literally as it says, I want to borrow against my ETH. I think like we've got that on the Summer.Fi homepage and stuff at the moment. But I want to borrow against my ETH. I give you my ETH. Effectively, I'll give the smart contracts my ETH, and the smart contracts give me back, depending on the protocol I'm using, give me back another token, often a USD stable token, whether it's DAI, USDC, USDT, or whatnot. But yeah, so that's very cool. But like, I guess always the big question is like, why? Like, why would I want to borrow against like my ETH or something like that? Like, I've bought ETH to hold, right? Like, why would I want to borrow against it?
Yeah, so I think what we see is like really three huge reasons, and borrow is an interesting one because it's I think the biggest thing that we see in DeFi generally, more or less, other than like the stuff that you do constantly, like swapping or stuff like that, trading in terms of like 1 inch aggregator stuff like that. So it's a really huge use case, basically. And so to your point around the why, I think it's really around three things, or three things that we see all the time, three things that we see customers coming to do. And the first one is simply just getting cash. You have something in the real world that you want to do, and you can borrow against your crypto asset in order to do that. Usually, it's higher ticket items and stuff like that, but not always. Like there's a interesting story of a user that I spoke to that was working in DeFi at some project, and when the bear market hit, basically he had all this crypto that he had accumulated over the bull run and the previous bear market, and he started working in crypto from some other industry, and unfortunately, like the project that he was working with, like didn't last basically. So he found himself without an income for an extended period of time, and was able to borrow against his crypto in order to get him through sort of this rough patch, so to speak. So that's number one, being able to borrow against your crypto for like a real world use, like something you actually need, like cash you actually need in your real life. The second one we see, and maybe I'll give like a personal example here, is borrowing for yeah borrowing for to be able to capture some type of like some type of yield spread. So basically, what we
like
see
a
in
basis
DeFi,
trade or carry trade, right?
exactly,
Sorry, yeah,
exactly,
like carry
exactly.
trade, basis trade, like that sort of idea. Yeah.
Exactly. So and kind of turning your underlying collateral into like a little bit of a yield bearing asset. And you still are taking some risk by depositing it wherever you're depositing it, but you're not necessarily taking like price risk, because you're not, going and putting that asset somewhere else in terms of like spending it or something like that. You should, in theory, always be able to call it or get it and then come back and pay back your loan. But the reason why people do this is to capture the spread between the rate of interest that you're paying to borrow and the rate of interest that you're getting from the place that you have deposited it. And a really great example of this actually right now is SUSDE. It's still slightly positive today. I think the yield at SUSD or with Athena is around 17%. But at one point it was upwards of 30%. And you had this quite large spread between being able to borrow on some protocols and being able to deposit on Athena, or in their vault, I think is 4626 vault. So you could just swap to it, I believe. So yeah, that is the second big thing. And lastly, something that is very interesting with these borrow vaults that you see more so in bull markets. So we're going to start to see it, I think, a lot more now, and you're going to see a lot more of these opportunities come up, is being able to sort of capture a little bit more upside from borrowing against your collateral, whatever it may be, ETH, Grab BTC, whatever it is. And there are two things there. First is being able to farm, quote unquote. So let's use Athena again as an example. Again, I'll use a personal example here. Is being able to, for example, you can lock USDE and earn sats, sats right now, shards before.
Yep.
And that's another way that you can do it. So you're not actually, and then you have an implied yield that you're getting, but it's denominated this time in ENA in this case, or some other token in other cases. So that's another way that people use borrow positions. And the last way is a little bit more degen, let's say, because you are taking on price risk, which is, hey, you can borrow against your collateral and you can go and buy other crypto assets that you might believe in. So let's say, you want to invest in a project, or you want to do an angel investment, or you want to buy a new token or a meme coin, even like Mog or Pepe or, something like that.
I forgot about Mog. Yeah.
I mean, Mog is great. You can do that too. And you can still keep exposure to your underlying, core holdings, and then go go bid some degen stuff if you'd like. So a little bit long winded, but those are basically the whys behind borrow.
Okay, amazing. That sounds yeah. It sounds really powerful, and I know like from our own data, right? Borrow is still, I think, probably the most popular product in volume terms on Summer.Fi. It was obviously the first product we ever had on Summer.Fi. It's kind of borrowing was kind of the birth of DeFi as well, right? Like basic borrow, and so on. When like kind of, I guess, as well yield like the kind of basis trade stuff you talked about. Like originally it was just like LPing into like, is it Uniswap or Curve or something early on, but now there's many more options as well. So let's talk about the values of it a little bit. Like you talked about you talked about a few things and so on, but like we obviously spent a long time last time talking about automation. It's like you're obviously putting a volatile asset and borrowing another asset against it and so on. Like automation is available across most of the borrow products, right? Obviously a little bit dependent on protocols and so on, but like a lot of users obviously still have a fear, like you still can't take liquidation risk with a borrow position, right? Even if you are lending it into another protocol, sometimes there's a lockup period and so on. But yeah, what is the like user experience like for borrow? And yeah, like you would use automation, right?
Yeah, so I think for borrow, you definitely should, I think, use automation, some type of protection, stop loss, trailing stop loss, or at very least auto sell, I would say. And yeah, you definitely take on, like all borrow positions are going to have a liquidation price, regardless of, what you're doing with the borrowed asset, whether you deem it to be very safe, whether you think you can always access it in time. You just really never know. And just fundamentally, like technically speaking, you're always going to have a liquidation price when you borrow against some underlying collateral. So yeah, I think that is a major consideration when people or users are thinking about which borrow position to get into, is this question of, well, does it even have automation for me to use, especially automations like stop loss and other protection automations. And on Summer, like, you should have access to all of these automations soon, if not already. But if that's not the case, then you definitely need to look out for, which of these have downside protection automation.
Yeah.
Although the other automations are, I think, less important for borrow. Auto take profit, auto buy, these, less important.
Yeah. Okay. And I guess like obviously automation is a big one, but when you look at borrow, then like it sounds like you are just using the kind of basics of a lot of the protocols, like the DeFi protocols and so on. So why would a user not just go to the underlying protocol directly? I mean, if there's a UI for that protocol available, right? Like some of the protocols that we support, like there aren't dedicated UIs, right? But for those that are, like, why is borrowing on Summer better than going to the protocol directly? Like obviously we talked about automation and the importance of automation, but automation aside, like what is there any other reasons why it's better on Summer and you instead of going to the protocol directly?
So this is a great question. I love this question because let me start with let me start with a brief story. So I was borrowing on I think last bull market 2021, and basically I was borrowing on one protocol, Maker protocol, and I had found myself in a little bit of a sticky situation where I needed a lower liquidation price, and I had there's no way I could do that with basically adding more like paying back debt or adding more collateral. I was out of bullets, so to speak. So the only way to do that would be to what we call in Summer, which should be on the app when this comes out or very shortly after, which is to refinance to get basically in my case, a better LTV. or a higher LTV, or in Maker's case, a lower collateralization ratio, but it was switching protocols. So yeah, for me, I had to do that manually because it was very difficult and scary to do that at the time without without the tools or without great UX to do it like on Summer or Summer will have. So that is really a huge advantage of using Summer over a protocol front end, because a protocol front end by its very nature will only give you what that protocol has to offer. So if you're on Morpho, you're going to get Morpho. If you're on Aave, you're going to get Aave, which is really nice, of course, because it's a nice entry point. It's a good way to maybe get familiar with a protocol, but you're not seeing the full breadth of what DeFi has to offer you. And that can be really scary because, there are some things in DeFi that you definitely don't want to get in touch with. Like you don't want to put you don't want to put your collateral or your assets there. But that's the power of Summer, I feel, is that, it gives you the best of being able to have that trust and that I would say trust of a protocol front end. Like you can really feel safe and secure, but at the same time, you get the options and you get the variety of being able to select, hey, if this is not working for me, I can switch to something better. I can get a lower rate on a different protocol. I can get a better, LTV. Or I can switch to a completely different asset if I want, or get rewards in some cases.
Yeah.
But yeah.
Yeah. Okay. Yeah. And I mean, I think the other thing that maybe it's my own personal use cases as well. And sometimes like I don't really use it on or I haven't used it actually on a borrow position, but it's one of the safety factors I've got. And that is the one-click actions to increase or decrease risk, effectively using collateral within your position to do it. So if the markets are falling quickly, and even if you need to, for instance, be like you've got a carry trade or a basis trade kind of going on, like you're capturing that yield elsewhere, like you said, or maybe even actually if you have like you've bought a large purchase against your collateral and you just don't have the capital to repay it now, and the markets are dropping, or even just feeling volatile in reality, you don't have to have the capital to close your vault, right? And at least and your position to just get it out. You can just hit that close button. You can just drag the slider to the left and decrease the risk, which is effectively going to sell some of your excess collateral for your debt token and repay your debt for you, right? Ultimately lowering your liquidation price further. Obviously, the net value of your position goes down, but they're all over collateralized positions. And every protocol has a liquidation penalty as well. So being liquidated is always the worst case scenario, whether closing your position or not. And if you're closing it above your liquidation price, and you're closing it for a better price anyway, in reality. But yeah, a couple of big factors there then on it. So like, if you look at Borrow today, there are like tons of different pairs that you've got. Like, how do you choose the right pair? Like, you talked a little bit, I think, about costs and automations and so on. But like, I guess the left hand side of the pair, like the collateral token, is somewhat easy. You know what the collateral token you probably want to use is, unless you've maybe got many. But yeah, how do you choose the right pair to borrow with, at least initially?
Yeah, so I think there are a few factors that everyone has to go through in their head, which hopefully we can make it really like easy for people to just think about these questions. So I'd say the first one, you kind of hit the nail on the head already, which is, what asset do you want to borrow against? Like, what assets do you trust basically to borrow and to deposit? So on the collateral side, you have to really determine like, what do you deem to be quote unquote fungible, which is just a fancy way of saying you think they're the same. So for me, I really think about wrap staked ETH, Rocket Pool ETH, and raw ETH itself as kind of very similar things. I'm happy to borrow against any of those. And then similarly, and I think maybe even more importantly, you need to really consider, what do you consider like safe and trustworthy to borrow. So in the case of a stable coin, for me, I used to really only care. I used to really only feel comfortable borrowing DAI. But now as things have evolved, the market has evolved and stuff like that, I'm really happy to borrow DAI. I'm happy to borrow USDC. And maybe the 2016, 2017 self would be like yelling at me, but I'm actually probably happy to borrow USDT today as well, which is maybe a bit shocking, but it's true. And so
yeah, it was always going to go. It's still here. It's
here.
Not looking like it's going to go anywhere. Touch wood.
Exactly. Exactly. Yeah. So yeah, I think if it goes somewhere, DeFi probably has a lot bigger problems today. If that happens. So yeah, happy to do that. So that's the first question. What am I happy to deposit? What am I happy to borrow? And then when it comes to borrow positions, you got to think about your LTV. And this is a question we get a lot because you'll often see similar pairs with different LTVs. And all this really means is it's how much you will have available to borrow. And higher LTVs will always mean that if you borrow the same amount of something with a lower LTV, you'll always have a lower liquidation price. So maybe that's a bit complicated, but basically, to give an example, if you have something with an 80 LTV and another thing with a 65 LTV, if you borrow, say, 100,000 USDC from both, the one with the higher LTV will always give you a lower liquidation price. And that comes at a cost because the protocol generally is bearing that sort of extra risk, and it's going to come at a cost to you, which is in the borrow rate, which is the next thing you need to consider, and that's the cost of the borrow rate, so the cost of capital. So you need to think, how much do I want to spend on this? On Summer, that's another thing that makes Summer great, is that you can easily see when you open the position how much you're expected to pay per year. So that's another thing you need to really take into account is the cost to borrow. And lastly, especially for borrow positions, related to that borrow rate is how much those rates are going to fluctuate. Can you think about them as being really predictable and consistent, or should you think about them as being really variable and going to go all over the place depending on the market movements? Maybe that's something you want to touch on in terms of the different protocols and how how users should think about the different protocols when it comes to rates changing and stuff like that.
Yeah. I mean, I think we can go deeper into the protocols later, or even maybe on a different call. It's kind of looking how far in we're already in at the moment. But yeah, I mean, I think there's a couple of obvious ones, right? Where you've got Maker and Spark. If you're borrowing DAI, are obviously like they're not fixed rates, but they're kind of they're not constantly updating. They're not real time rate adjustments on a rate curve or anything like that. They're generally set by external teams that adjust them at most every week, more often than not every couple of weeks or months. At times, kind of depends what's happening in the markets more generally as well. But then you compare that to the likes of Aave, Morpho, and even Argno as well. That's on Summer at the moment, or those protocols on Summer at the moment. They move depending on utilization. Argno is a little bit slower. The rate can only update once every 12 hours, so you don't get if you get a huge withdrawal on the lending side, for example, it isn't instantly going to change the rate, or if it's gone beyond 12 hours since the last one, then it's only going to change by most of 10% of the current rate. But yeah, Aave and Morpho and stuff in particular, they can fluctuate around quite quickly, and you've got to be a little bit careful, I think, at times when you're looking at the rate and trying to understand if that rate is just like I think we've seen it before, especially with USDC, when USDC was doing some like funky things and so on, probably about a year ago or so. But like the rate would jump to like 17%, and you'd be looking at thinking, wow, 17%, that is high. And then a couple of hours later, it was back down to like 8% or 9%, simply because maybe a big lender had just withdrawn like USDC from the lending side on Aave and moved it elsewhere. or like wanted to maybe turn it into ETH or WBTC or something like that. So yeah, you've got to sometimes take a little bit of time and context to say, okay, what is the rates doing? Like, what is the more like blended rate over like the last 24 hours or 7 days or something to give you a good indication of exactly what that is. But yeah, I think we could talk a lot more about protocols, maybe on a different call as well, because I think it would take us probably about an hour or so just to talk about the differences and comparisons between the different protocols. I think today it's more about am I trying to borrow? Am I trying to multiply? Am I trying to earn? Or all those things? What is it I want to do, and what product is best for me in that sense? Totally. And maybe making an assumption of like all protocols are equal in some ways, even though every protocol will tell you that they're better than all the others. They all have their pros and cons and trade-offs and so on.
Definitely.
But yeah, I think that's great, and I think that's an amazing summary of Borrow though. And if I can just kind of try and wrap Borrow up, really, it's you've got an asset and you want to basically borrow another asset against it without giving up custody of it. Obviously, everything in Summer.Fi is self-custodial. So when you deposit it, only you can access that in a borrow position, that collateral, and as providing you maintain those minimum kind of like LTV requirements and so on. But let's take it on to Multiply, because Multiply is obviously it's a summer feature on top of Borrow Vaults. But it has very different use cases. I mean, there is an overlap in places, but what is Multiply, Jordan, at a high level?
Multiply, I think of, as the easiest way basically to amplify your exposure to some asset. So amplify your exposure, like what does that really mean? All it means is you want to get more of the underlying thing that you're borrowing against. So a lot of users that I've spoken to, or myself generally, my bias is certainly to be long. I mean, if you're in crypto or DeFi, like I think it's in your best interest to be long most of the time. It's, I think, a lot easier too. But basically, regardless of being long or short, it's just really amplifying exposure to that underlying. So you get to stack more of that thing that you're borrowing against. So perfect example is you have ETH, just trying to stack more ETH. You have wrap BTC, just trying to stack more wrap BTC. And so the protocols here, I think, as you mentioned, like I think for this conversation, it's fine to really think of them as not commodities, so to speak, but as like you can think of them as very similar in terms of what they offer in terms of borrow. But the real key thing here when it comes to, as borrow actually, but when the real key thing here when it comes to Multiply is really the automations. I think actually that sets it apart. It's just so it can really make or break your Multiply strategy basically by using some of these different automations that Summer offers, and making that underlying thing, that core goal of being able to just stack the underlying thing. In my case, I love ETH, being able to stack more ETH. When the bear market is here, you can really just try and stack it up. Or when the bull market is about to come, like it is now, you can really just keep stacking it up. And that's beautiful. Because last thing I'll say about Multiply is one thing is really nice on Summer that we heard from a lot of users. Because originally people were doing this manually and it was really hard to do and cumbersome. And in Summer, it's just one transaction, one click to do it. But
they were doing it manually. They were doing it manually through a Borrow vault, right? Like this was before we had Multiply. Exactly. We only had Borrow, for example. Exactly. So they were doing that manually. And what would you have to do it manually? Like just talk that through very, very quickly, because it's a kind of a long-winded process, right? But what were users like? You were speaking to them on like a daily or weekly basis, right? What is it they were doing?
Yeah. So you would see like they would say it's interesting because they wouldn't come out and say that they were doing this, but you would hear a lot of people just saying that they're doing the same thing, which is they say, hey, I go to, at that time it was cdp.makerdao.com, and even Oasis for a little bit as well.
The good old days.
Good old days, yeah. And they would
Yeah.
deposit ETH, borrow DAI, or if they're on Aave, borrow something else, go to an exchange. Uniswap, I don't think even 1inch was like really there at the time. Swap to whatever the underlying was, come back, put it back, borrow more, go, do it again, come back, put it back, do it again, do the calculation of like, okay, like what is my multiple? Like how much more do I have? How much should I start with? How much more do I have now? Or how much less do I have now if I were to pay back now? So it's I think I'm glad you asked that question because it really shows the power of things like Summer. You know, it's one click, it's one transaction. You have all of the data that you need to see right there. You can see, you know, I would say we have the best P&L surfacing in DeFi when it comes to multiply, is you can see exactly the major question that people ask when they do this is, hey, how much more ETH do I have now than when I started? And in Summer, no calculations, no nothing. It's just like you can see it right there. In some cases, it's how much less ETH you have, but we won't talk about that.
Yeah, absolutely. We've all been there, and it's been a negative number, right? I think we only had to look internally at our data, kind of at the end of 22, early 23, when like the percentage of our active users were like in negative P&L and so on, which is looking much brighter today, and so on. But it's interesting how you describe that thing, right? Like the kind of the manual multiply in some ways, that you would use a borrow vault, you would do all those transactions, multiple different interfaces. If you're conscious about security, multiple approvals over and over again, as well, because although it was like best practice at the time from a UI point of view, just to do like approvals.max, or whatever, like I would highly recommend you never really do that. Like for example, in Summer, it will only ever get you to prompt you to set the approval for the deposit you are making and so on. But multiply in a nutshell then is literally that manual borrow done in one transaction, right? Like you are, and just to give an indication of how that's working then as well is you're depositing, let's say you're depositing 100 ETH, you're trying to go say like 3x ETH long against a USD stable, let's say USDC or something. And it's just going to borrow. It's going to flash loan a ton of like USDC or DAI, for example. It's going to swap that to ETH. It's going to deposit all of that ETH plus your initial deposit into a position. It's then going to borrow the USDC amount and repay the flash loan. And in that one single transaction, you are there. You don't need any other user interfaces. You perhaps need one approval at the start, depending on what asset it is you're depositing. If it's like wrap staked ETH or Rocket ETH or anything like that, you got an approval and you're going to execute transaction. And on Summer, it shows you all of the information that you need to make that decision as well, right? It's a trading style interface without all of the daily or minute charts or anything like that. But it shows you your price impact. You can control the slippage, and so on, right? And it shows you kind of end state, and you're in reality just picking that multiple. I think, right? So, yeah. Plus all the other bits and pieces. Now, I'm always excited to talk about multiply, because I know we're both like pretty powerful multiply users on Summer. Like we've always kind of like built, like we're always the kind of we build the features, often build the features that we would use ourselves, provided like we found others that would use them as well. I've got tons of work going on outside. I hope nobody can hear this going on. It's all I can hear in my
but it's okay. I think it's
okay, good. But yeah, like how do you set up your multiply position? Like what do you do? What are the steps you go through for it?
Yeah, so I think around choosing a multiply position, it's very similar to borrow. But I think, again, thinking about the questions that users should really go through is similar, same thing to start, is what do I want to get more exposure to? What am I happy to get more exposure to? For me, I really think about wrap staked ETH, Rocket Pool ETH, even raw ETH as very similar. Even though some have a staking reward and some don't, that's fine for me. So yeah, really need to think about that. Then even the same as borrow, you really need to think about, what am I comfortable borrowing? Again, for me, same thing. It used to be just DAI, but today I'm happy to do USDT. I'm happy to do USDC. I'm happy to do DAI, whatever. All are good for me. Then the next thing you need to really consider again is the LTV, and the same thing applies here, but I think it's even more important when it comes to multiply, just because of the nature of what you're doing. Like, you want that, or at least I want that liquidation price to be as low as possible. And I want to be able to get more of a max multiple, is what we call it on the interface, which makes it really easy for you to see, can you go, it's very correlated or one-to-one correlated with the LTV, higher max multiple, which means you can take more risk, so to speak. You can get access to more and more, being able to get more of the underlying in one transaction. But it also means that if you don't actually use all of that buying power, so to speak, you'll have a lower liquidation price, which for me is very important. And you're going to pay for that. It's going to be expressed in the borrow rate. But you should really think about and consider that when you look at the borrow rate, you have to think, unlike a borrow position where you have a very defined upside, so to speak, if you're doing a yield spread, that's really important to think about the borrow rate, because it's going to impact your P&L in a material way. Or if you're taking on a loan for something to use in your real life, that borrow rate really matters, because you're going to have to pay it back, and you're going to be counting the pennies to pay it back. But when it comes to multiply, if you really get it right, it's not to say that the cost doesn't matter. Obviously it does, but it matters a lot less than something like borrowing for those other use cases in a borrow position. So yeah, borrow rate, LTV, max multiple, what do you want to borrow in terms of the debt, what you want to borrow against in terms of the collateral. Those are the major considerations. As well as the two last things that I think would be great to talk about in a little bit of depth is also token rewards. Is that something you care about, being getting token rewards in order to multiply? Maybe, maybe not. And then lastly, the really important one for me at least, and a lot of other users, is automation. Because I think it's really something that can make or break your plan, your bull market plan, if you use automations right. So yeah.
Yeah. I mean that automation one is critical. I've got a couple of multiply positions open on Summer at the moment. Although I feel like when we're doing the automation discussion, right? I'd recently stop lost again. I think on Friday in one of my positions, but that goes back to that same conversation that I'm so conservative. I'm paranoid about losses, but I have a position open on Archna, multiply position on Archna, for example, because the asset isn't available to multiply elsewhere, and it's a sizable enough to worry me, because we don't have automations yet on Archna. Archna's a much more complex beast than any of the other protocols we have, because there are not fixed LTVs or anything like that on, and there's a number of other kind of rules where you can't actually adjust your position if certain conditions are present in the pool and so on. So it makes it far much more complicated in reality, but we will have solutions for that soon. But yeah, I have this multiply position, and I mean my liquidation price is a long way away, but I'm actually it's still just the fear of loss that eats me up a little bit. And when we saw the markets move like we did the previous weekend, I didn't even go and check. It was actually on Spark, where the one I got stop lost. I'd almost forgotten about it. I was so relaxed about that position, that multiply position, because I had the stop loss set up, because I knew that that worst case I'm stop lost. And I'd forgotten to look, and it wasn't until Monday I even realized I'd been stop lost on that position. but like Friday when the market dropped, Saturday when the market dropped, like I was there checking. In reality, I was checking like how much I'd lost, like how far was my P&L down on those positions, and just making sure like something crazy happened with my liquidation price and so on. But that like kind of constant rational fear really of like what is happening with that position, like do I need to close it? Should I close it at a loss? Like the emotion, like all the emotional thoughts about it, instead of the kind of like head thoughts, like I had with my Spark multiply position, where I was like, I'm good. Like doesn't matter what's happening. I've got my stop loss on the downside. I've got my take profit on the upside. Although unfortunately fallen further and further away from that take profit price that we talked about, I think on the automation call.
Yeah.
but yeah, I just completely like forgot like about that position in reality, and that's kind of how it should be. But yeah, I have my assets that for me from multiply, I have the assets that I want to multiply my exposure to. Automation is incredibly important. Like I said, this asset that I've got on Arjuna, if it was available on another protocol that had automation available to it, I would be using that protocol with automation. To be completely honest, like that was a deal breaker for me in some ways. If it's available somewhere with automation, I would use it with automation. Like that's a kind of minimum requirement for me. However, on Arjuna, I am also farming Arjuna tokens, which also makes me like puts a smile on my face, and in some ways, it never kind of like negates the risk, because the like you're never going to farm as many tokens compared to the potential loss in your asset, right? Like farming is never ever going to replace it unless you end up in a super low cap token that's suddenly like 1,000x's eventually one day and so on. But the chances of that are slim for the amount of tokens ultimately you can farm. But yeah, for me, like I'm pretty protocol agnostic now. I used to just use Maker. But although probably the internal bias of like when we both like kind of when we worked at Maker and so on and like had that connection to Maker and truly believed in the Maker world, like protocols are moving on now, like new developments and so on. I trust them all as well. Like everything on Summer, I trust like with my wealth. And yeah, and like the borrow rates are fairly even across the board. And I'm like you now. Like it doesn't really fuss me. Like generally DAI and USDC are the ones I go to by default. But yeah, like for me, like multiplies, like you said, it's a great product. Choose your multiple exposure. You can see your P&L. Like the P&L is the thing I look at constantly. Like market moves. Wonder what P&L's at. And so on. I wonder what my net value is at now. Like you click on the net value box or the P&L box and it shows you in dollar terms. It shows you in collateral terms. It shows you P&L and collateral and debt terms. Like it's a really solid experience. And you've got the sliders to be able to adjust it. I've got the one-click close if I know I need to in an emergency situation, a kind of Black Thursday or Lunar Terror May Day, and so on. And then we got the automations, right? Which again, like you gotta try them. I think to really understand them. I think, and in some ways, like you almost want to like be stop lost in some ways, right? To see it working and
see it works,
and feel it working. I think I was just like the stats on the Summer.Fi page today. I think there's something like there's been 360 like automations trigger. It's in the last 30 days or something. Like the markets have been active. They've been busy, and the automation bots have been firing, whether it's basic sales, like a lot of sales, a lot of buys, so kind of like keeping people in the market, and then like days like Friday and Saturday we see the stop losses kicking in. But for me multiply is the prime feature I use on Summer. It's the main reason I would use Summer over the protocol front end as well. Like is all value added features. And totally. if you're just trying to increase that exposure, and I think the critical thing as well is multiply on Summer it's not designed for the short term trader, right? I think that's the key and probably the only thing that maybe you didn't touch on. around.
Yeah.
Like it doesn't give the 50x or 100x exposure. It gives you the 3x, the 4x, the 5x. And yeah, if you're keeping your position or intending to keep your position open for the long term, weeks, months, like with the automation tools that are available to you, with the take profit, like partial take profit tools as well, it's a perfect position. There are obviously, I think, if we're open, like there's lots of like perp protocols popping up all over the place. Like the perp protocols are really coming back hard in DeFi at the moment. But like the funding rates when the markets are going up are huge. You can obviously get much more exposure to the asset, like a much higher multiple. But you pay a large amount for that, and you get the kind of the 30-second charts or the 1-minute charts that you can study intensely. But typically you see the users there, like if you were to compare the average like kind of lifetime open of a position, like the Summer users would have a much longer average lifetime than the perp protocols. Right, the perp protocols are probably minutes to hours to maybe a couple of days. On Summer, you rarely see a user open and close. Very rarely in a day, pretty rare in a week.
Absolutely,
like that's a key use case for Summer, really, more than anything else. Within and using protocols like Maker, Aave, Spark, and so on is they're longer term positions, medium to long term positions. If you believe over time in an asset, and you believe in the kind of long term trend, then yeah, it's the perfect tool for you. I think. So
yeah, totally agree.
On Multiply, then the final product on Summer.Fi is Earn, and we have two types of Earn products in reality that we want to try and talk about. We've kind of got a basic Earn product, and we've got something called a yield loop product, which is actually kind of just Multiply with a different UI a little bit, right? So let's jump ahead and talk about the more advanced Earn product first, because it's so similar to Multiply. So let's talk about yield loops. What is a yield loop Earn position? What is it and why would you use it? And then after we've kind of talked about that, we can talk a little bit more as well, and kind of very basic Earn, and kind of end on simplicity in a way. So what's yield loops?
So I think first, before the yield loops, I think the big thing about Earn, which I love about Summer, is that it gives you that versatility. So you can really be taking risk, quote unquote, with one side of your portfolio, and like have your other assets that would just otherwise maybe be in your wallet. They can be working for you too on Summer, which is great. And conversely, if you close a position, from borrow or multiply, you can right away going into Earn on those assets that you just maybe made and multiply, for example. So that's first. But when it comes to yield loop, first at a high level, I think it's really around very similar to Multiply. You are on the collateral side having an asset that generally has some type of yield, or the value of it. You can know that it's going to go up relative to the thing that you're borrowing against. So, for example, staked ETH versus ETH. The staking yield of staked ETH is going to go up relative to just the raw ETH itself. So what the yield loop is basically taking your staked ETH, in this case, this example, the collateral, borrowing against it, going and getting more staked ETH, and then effectively going like multiplying that exposure to that staking yield.
And crucially, you said borrow an asset. You're borrowing ETH, right? Like you borrow the correlated. Exactly. You borrow the kind of the non-yielding correlated asset.
Exactly.
In reality, exactly. Yeah.
And in this, that can be ETH. In a stablecoin case, it can be a stablecoin as well. And the other thing here, which I think is really important to touch on, because I think we should really get into detail around how users should think about how to choose a yield loop strategy, what asset to choose, how to choose what collateral to choose or a staking provider in some cases to choose, because the thing that really matters for the profitability of this strategy is the borrow rate. Because if the borrow rate goes up higher than the yield that you have exposure to, it doesn't make sense. It'll be a negatively yielding position for you. So it's a real benefit of Summer, because in our yield loop UI, it's really easy to just see if it's going well, if it's profitable or not. But to understand why that is, it's really important to understand how these borrow rates work, and how to understand like which one to select. Because when you go to Summer, you'll see that there are a bunch of different yield loops options. And I think this is something that we can really help customers, help users to understand is, what are the series of questions that they should go through? What are the things that they should look at when deciding which yield loop is right for them? So yeah, maybe it's a bit long-winded. Hopefully I answered the question, but yeah, I'm actually quite excited to go through how a user should think about choosing a yield loop position, because it's actually something that's kind of I've stumbled upon myself quite a few times. So yeah.
Okay. Well, I mean, I think let's just jump straight into that then, right? So, like, I mean, just as I understand it, yeah, you've got a collateral asset which is earning a yield. You've got a debt asset that you're paying to borrow, which is correlated to it. I guess in my head, the obvious thing that you're going to talk about is long as the yield on the collateral asset is greater than the borrow rate, you're going to make a profit, right? But yeah, maybe you've got a few more things in here that you like that go through your mind. So yeah, why don't you tell us about them? Because I'm sure it's going to help all of our users actually choosing the right position at that point, right?
Yeah. So the first thing I think the question is like, well, what type do you want to do? Because you can do ETH, you can do stablecoin one, which in a lot of cases has been SDAI in before. I don't think it's profitable anymore, but it was for a very brief period of time. It still is. Okay.
On things like on like Arjna and so on, it is like I don't think it can ever really be profitable on Aave and stuff now. I think the DAI borrow rate is always effectively going to be more than that. But somewhere like Arjna, where the lenders are ultimately controlling the rate for supply and demand stuff, I think it's still a fair bit to earn on that one.
Wow.
I think.
Okay. So there you go. Then you have SUSD E, which is a relatively new one that's popped up, where it's very interesting. And then you have, I'm not sure I would actually consider this a yield loop, but maybe, because it has an implied yield, which is USDE and then some stablecoin against it. And then the last one that's relatively new is restaking, where you also have a yield loop, which is a whole different other thing where you have many different questions to consider, which is doing the same thing with EETH and Easy ETH, I believe, which have other questions that you should be asking yourself around whether it's something that you should be doing or not doing for you, or if it's right for you. So yeah, that's the first thing, is which type do you want to do? Then from there, you really have to ask yourself around the provider of the yield, where the source of the yield is coming from, and what is the yield going to be? How sustainable is it going to be? So you kind of have to figure out for yourself, like, or go to the provider or go to the asset and really understand where is this yield coming from? How much is this yield? Is it going to stay this way? So yeah, that's the second consideration. We talked about the borrow rate. That's an obvious consideration, but we make it really sort of easy on the Summer UI to think about that. And then lastly, which is probably the most important thing, is the risk. Because all of these positions, unlike a lot of other yielding positions or earn positions, have liquidation risk. So you need to be cognizant of, well, how much risk do you want to take? And what should that liquidation price be, which can be a little bit hard to reason about because it's not like a price that you might be checking out every day, like the ETH USD price or the Wrap BTC, USD price. These prices can be a little bit strange because how often are you thinking about staked ETH relative to ETH? And the price fluctuations there. So you need to consider what's the worst that it's been. How bad do you think it can get, and in what circumstances do you think it can get that bad? And in some protocols, which is something that I don't think we surfaced, but maybe we should, is some protocols assume like a 1-to-1 for these assets. So you still have to be concerned about, liquidation and concerned about the risk there, but maybe you can be a little bit more aggressive than you would be otherwise. So yeah, those are the main considerations to take into account when choosing a yield loop strategy. So there are quite a few, and it's something that you need to think about. Is that how you think about it, or how do you think about it differently?
Yeah, pretty much. Yeah, I mean, like I said, the key thing really, and I think we see this in the activity as well, is in our users, which is like when if the borrow rate's greater than the yield rate, then it's not great, and because you're like sometimes like you're 8x, 9x, 10x in these positions, it can very quickly you can lose your gains as fast as you can get your gaining there effectively, because if your yield rate is 2% above the borrow rate, then great, you're maybe earning like at 10x maybe like an extra 20%, and so on. But if the borrow rate suddenly shoots up like to say 4% above the yield rate, then and you're 10x, you're suddenly losing maybe like 40% on your yield. And we've seen this a little bit with some of the Morpho DAI ones as well, whether even now, and I was just having a quick look as we were talking, there's someone there, the long USDE one. I'm not quite sure which one it is, but it's the max multiple if like an 11.5x max multiple. The borrow rate's 55%, and the yield, the yield on USDE is difficult, right? Because it's just you're earning those sats and so on. Yeah, the USDE, the SUSD one is maybe a little bit easier to comprehend a little bit, but that one was super high at one point as well. I think in the 50s or 60%. And again, it should arbitrage out pretty quickly because people should get in and out, and so on when it isn't profitable. But yeah, we've got some around there, the 22, kind of several at like 22.5%, and yeah, the APY at the moment for SUSDE is just 23%. It says, but I mean the liquidate. I mean, I'm a big user of the US, the wrap staked ETH one, on like Aave and Spark protocol? And so on.
Aave and Spark.
I think I've got Aave and Spark on there, or I have Aave. Did I? And I think I opened a Spark one as well when the rate was super low on Spark, as well. Again, the borrow rate I'm talking about there. But I am super confident, like with those tokens, like pre the kind of turning on the withdrawals, there was always that, like there was a small discount, like wrap staked your staked ETH always was trading at a discount, and we had that period I think in November 22 when the rates were pretty volatile, right? And I think it dropped to about like as a ratio down to like 96, I think it was, and liquidation, those big liquidation points in the market around 94, 95. But since withdrawals have turned on, like actually you can always just take your staked ETH, and you may need to join the withdrawal queue and so on. But you're always going to convert that back to ETH eventually, and so on. So I'm fairly confident, unless obviously something goes wrong with validators and so on, which is wrecks probably everything anyway. But I'm fairly confident of that. But like SUSDE, like I think that was trading at like a 2.5% discount quite recently. And so on. They've got the 7-day unstaking period, so the secondary market then trading like when the borrow rates went up and people maybe kind of over leveraged and so on that position, like they need to repay it. You have to kind of buy it on the market, and so on. And in theory, that should have pushed it up or whatever, but in reality, like people were over leveraged and it pushed it down because so many people were selling it, as well. Is that the right way around? Sorry, no, they're selling when they're trying to deleverage. They're selling it, right, and it's pushing the price down, and so on, right. So they would like maybe the rates went up, they needed to like de-risk their positions and so on, and selling it then obviously created this thing, and I think there was a liquidation somewhere, a big liquidation somewhere. I think someone went. I don't think it was on Summer. Pretty certain it wasn't on Summer, but someone went extremely hard or close to the max LTV. And then the borrow rate goes up, like you obviously get there, but and then when it depegs a little bit, but yeah, like I wouldn't go as hard, as close to the max LTV on the SUSDE one, for example, than I do on the wrap stake teeth one, just because my confidence in the wrap stake teeth one is so much higher.
And when you say point, confidence, but it's not to interrupt, but when you say confidence, there, you're really talking about the tightness of the peg, or not the peg, the ratio between, or the price really between wrap stake ETH and ETH.
Yeah, I mean they're correlated assets, right? So like obviously when it's wrap staked ETH to ETH, it's a little bit different because the wrapped version is not 1-to-1, but you kind of need to look at the staked ETH thing because you can just unwrap it at any point. But yeah, how likely is it's going to hold that 1-to-1 ratio? And if you just need to look back since withdrawal started, right, it's held it well. But that's really the kind of confidence level that I have. So when picking a asset, so same as like when we did Savings Star USDC, that yield loop, for example, when Maker voted to push the SDI rates, I think to 15%, but the kind of general market yields were still only 7 or 8% at the time, maybe even 5%. It was a super strong trade because you kind of knew that DAI wasn't going to kind of depeg it like under, at least there probably, against like USDC. So it was a really solid strategy, and you were confident in that peg mainly because of the peg stability module, the PSM, at Maker. So ultimately, I think when choosing a strategy, the biggest thing for me, the two main things for me, is the borrow rate less than the yield, and is it sustainably less than the yield? Like that's maybe the issue at times with the SUSDE one. And am I confident in the peg? Because you are yield looping and increasing the exposure to the peg, and any movement in the peg is amplified by the amount of exposure that you have in your position. So it's kind of about it's a hard no if the borrow rate is always above the yield rate. And then it's about confidence in the peg, and the confidence ultimately then leads you to your risk exposure. Same way as in how much risk you want to take on multiplying ETH against the USD stable when the market's going up. If you're very confident the market's going to keep going up, you can take more risk. If you're unsure, you take less risk. But I would add that the yield loop strategy, I opened my first yield loop strategy at the end of 22 through summer. I opened another one in 23. And it is the perfect, not financial advice, risk asterisks and so on. It is the perfect crab market strategy. When that market was bouncing around pretty much sideways in 23, so on, just kind of fluctuating. I mean, you zoom out and it's going up very slowly, but I wanted to keep that ETH exposure, and I wanted to earn on that ETH as much as I could. And I think over the entire lifetime position, I've averaged about 11 or 12% on that ETH. So I'm 12% up over that whole year or whatever on my ETH than I would have been had I not been in that strategy. I'm still holding my ETH. I took the ETH gains. You still get the market gains to it. It's exactly the same, really. If you believe in the peg, you're still holding kind of that spot market, the 1x exposure to the asset. But you're just earning on everyone else's kind of fees of using the Ethereum network and the staked ETH one. Same with SDI USDC strategies and so on. Maybe now in the SUSDE strategies, great crab market strategies. That the Athena ones, obviously, you're earning a ton of Athena rewards as well. Kind of almost regardless of what protocol you're using. Some protocols you get extra, but they're great crab market strategies. And if you're the USD ones anyway, look, most people are holding USD anyway within crypto, whether it's DAI or USDC or USDT. So why not? You would expect a return in your bank account if you've still got a bank account. Why not get a return for it if you can in crypto? And like we say, Summer is the best place to earn on your assets that you're holding. We show you more information, I think, than almost anywhere else. And yeah, that's why I use it, because you can see instantly what is my liquidation price, what is my loan to value, what is my P&L, what is the current APY I'm earning on this. And I know on our roadmap for this quarter, we've got some one-click carry trade options. We talked earlier about carry trade or basis trades earlier on. Ultimately, the optimum strategy here is you have maybe you have your ETH and you want to borrow, maybe DAI against it to go into the SUSD DAI strategy or something like that. Right now, it's still multiple clicks, multiple positions. But I know probably within like the next 6 to 8 weeks, that should all be done in one click, right? And it will be a unified interface as well. So this is how much you're borrowing against the main asset. This is how much your yield loop position is also yielding you. And maybe a tiny bit further down the line, there's some automation in there as well, right? Where if it becomes unprofitable, it can just close that position out for you. So again, you don't need to be checking every single day, like, is it still profitable? Is it still profitable? Still having to do the math. So regardless of how much information we show you, like, it generally is always information that you need more of to make an even more informed decision. But the automation can do that for you as well. But yeah, yield loop strategies, ideal. Crab market strategies, ideal if it's just an asset you're holding long term that you don't want to increase risk to in like standard multiply ways. And yeah, again, all in one transaction, open, adjust, close. Yeah, that's why I use it on Summer. I mean, and just to be fair, like, you could do this on the underlying protocol UIs as well, right? If you go to the Morpho UI, you could do it on the Morpho UI. But where most of our users are like 7x, 8x, 9x exposure, I'd be like 15, 20 transactions to get to the same exposure to earn the same yield on, say, Morpho. The risk of a fat finger bug, the risk of misreading a price impact or slippage input, and suddenly you're wrecked. Like, on Summer, it's one click, and yeah, I was gonna say it's superb. But yeah.
Wow.
Anything else from your side on it?
Helpful for me. That's been helpful for me. I actually have been on the fence around the yield loop strategy for me for a while. I had one for a while, a ETH one for quite a while, but then I was getting ready because, as you say, the market was turning. I was getting ready to position myself for multiply, but it really makes me think around, the long-term idle ETH that you might have, that I might have, that it makes a lot of sense for it to just be in the yield loop strategy. So it was very helpful for me. And just being able to think through it. Yeah.
Yeah. I mean, from my own point of view, I probably, like, when I opened it, I fully expected, I think, to close that position when the markets were turned. But it's doing me solid. And in some ways it's not a full hedge or anything like that, but it's in some ways hedging to, if something, like, I did lose a load of money on my multiply position. I've still got that as the backup in some ways. So yeah, like, that's kind of how I look at it. And like I said, when I went in, I expected to close it once the markets returned, but yeah, it's a pretty solid 12% still at the moment as well. So yeah, I've got no reason to close it. Basically.
Yeah. Okay. Cool. That's great to know. Yeah, very helpful for me.
Yeah. So we're just over an hour. We've talked about the complex earn strategies, but there's also some very, very basic earn strategies as well available on Summer. Some of them aren't, like, well, there's Arjuna, which is not as easy to fully grasp and understand. And I know you've done separate videos already with David from Arjuna as well on that. But talk very briefly, because we haven't got too long left, about the basic earn strategies. What are they? What are they for? How can users get into them really easily?
Yeah, so on Summer, I really think of these basic earn strategies as, like, the easiest entry point into DeFi in a way. Because you first, again, you can always think about what is the asset that you want to use or you want to have exposure to. Generally speaking, I think you can think about it in terms of stable coins and ETH, more or less, wrap BTC too. But yeah, so these basic earn strategies are basically just that. They're quite passive. In fact, extremely passive on all of them except for Ashna, which maybe we can talk about in a little bit of a segmented way. But yeah, I think the main thing around these ones is that one, they're extremely transparent where the yield is coming from, and with their it's quite passive to understand or to predict or to forecast in a way how the yield is coming in. So mainly what I'm thinking about in that regard is the DAI savings rate, which is like just the most vanilla, basic, easy way to get started. And I think, easy to understand, easy yield. Yeah. So, yeah. How do you think about the basic earn ones?
Yeah, I mean, I'm like, they're super simple to use. They're great for like newer people coming in. We've got some of like the Metamorpho ones, the Steakhouse ones, for example, in there at the moment. Where you're ultimately just lending, right? You're giving liquidity to the market. Instead of like the yield loop ones and some of the more fancier earn products that are likely to lead you to giving you better returns. You've obviously got the risk added to them, but you're not adding liquidity. Like you're still using the liquidity in the market to generate that position. The basic ones are you're providing liquidity to the market in a very simple way. Whether that's providing liquidity to well, not so much to maker in DAI, but you're helping DAI keep the peg in some way by locking up the DAI and keeping it off the market. So almost the opposite of like adding liquidity to the market, but like you're helping maintain liquidity in some ways by maintaining the peg. But whether you're lending to Aave or Morpho or Archna pools, you're just providing liquidity, and DeFi requires liquidity to run. Like the more liquidity there is in the market, often the better rates there'll be in the market, which again, arbitrage is kind of back out again because more people can do more things with the more liquidity that's in the market. So it is super basic. It is the lowest risk options we have on there. It's the easiest ones to understand. Like providing this asset gives you this return. Like no borrow rates to worry about. Like no negative rates or anything like that. Like it's simple. Like what you put in, ignoring gas costs and so on. And that like kind of like elephant in the room sometimes on mainnet and so on, and not knowing what the gas cost might be to get out of a position, which can be difficult to help predict your future earnings and so on. You're going to have more of the underlying asset at the end whenever you close. So yeah, it's super simple. It's probably got the lowest sell in some ways for using on Summer, except you've got all of the different protocols in there for you, right? So when you want to, like you talked earlier about refinancing and so on, if you want to just switch from one product to another product, it's super easy to. And again, don't want to give away too much, but very soon you're going to be able to have it auto switch for you as well. Very soon, hopefully, right? So there are still many reasons to have it on Summer. And if you want to ever convert that to a multiply position, that's going to be super easy in one click. Borrow position or multiply to earn or closing from multiply to earn positions and so on. But basically, I mean, I don't even really use them. I don't like really. I used to be a user of the DSR and so on, but now I use the DSR yield loop, for example. Yeah, they're very good. Actually, the only ones I do, that's a lie. Actually, now I think I lend on some of the Argent pools because to farm the Argent tokens. But like that is like, but that's more from a farming use case more than anything else.
Right. Okay. Wow. That's I personally, I think I use them quite a bit just for savings and stuff. Actually, I don't know why. They make me feel safe for some reason. But I mean, after this, it's making me reconsider the yield loops, honestly. So, yeah, that's good. Yeah.
Yeah. I mean, you just got, again, we go back to that same thing. Like, if you trust the peg, then you're in some ways like it's no different to just basic lending it, except you're getting more yield. but yeah, you've got to like it comes down to the trust, like not really in the protocols or somewhere, but in the token itself, and the peg, because it's the peg that can wreck you the fastest. If the peg breaks, then that's the fastest way to lose money and so on. But we're coming to an hour and a quarter, which is also the length for the automation one, and I'm very conscious it's a very long one. So I want to try and wrap it up. But what I want to do to wrap it up very quickly is I just want you to give one sentence which sums up each one of the products we've talked about. So in one sentence, remind us again, what is Borrow in one sentence?
Borrow is the most flexible way to use your crypto assets in DeFi in like a useful way without selling them.
Cool. And Multiply.
Multiply generally is just a really easy way to amplify your exposure to pretty much any asset, but mostly BTC and ETH, wrap BTC and ETH. Though I would say when it comes to specifically Summer, all of that, but you can set and forget your strategy at the same time with automation.
Cool. And then yield loops. We'll see how much you've been listening now.
Yield loops. Yield loops is similarly the easiest way to amplify your exposure to staking yield. So I like to think of it as boosting your staking yield or boosting the yield on some asset. What I learned today is it's nice because in a crab market, it's great in a crab market to sort of keep earning in a way. And lastly is you can trust it if you trust the peg, which I know now is way over a sentence, but I learned quite a bit. So yeah,
that's fine. That's fine. And what about basic earn? Just to sum it up in the very final one.
Basic earn is just deposit and forget. Come back and have some more money than you started with.
Awesome. Yeah. Cool. Great. And all of those things are better on Summer.Fi, right? I think that's the overriding conclusion I've at least come to after speaking to you about all this. But yeah, I think we can wrap it up there. Jordan, thank you so much again. I think we'll do another one of these soon, talk about the difference in the protocols and so on in a similar sort of way. Yeah. We'll go through each protocol that we support, the pros, the cons, the trade-offs, like kind of what they're probably best for as well, because each one definitely has the things it's better for, and so on. But yeah, thank you so much. I really enjoyed it again, and I don't know how we got to like an hour and 20 almost, but yeah, it was great fun. Hope everyone has enjoyed it. If they've got this far again, and yeah, we'll catch you soon.
Thank you.
Use Summer.